Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thanks for having me.
Man, so we've had a little bit of a Bitcoin and crypto liquidation shakeout that happened over the weekend. Bitcoin's now in the 112 area. Again, been in this area a long time.
So I mean, we've rebounded a little bit today. Trading closer to 114K as we speak. So yeah, you had a lot of liquidations over an illiquid overnight weekend session. Basically Sunday night, and that was driven by some selling flow into thin liquidity that caused liquidations, and so crypto did trade down. You've also had a bit of equity weakness today and yesterday with SPUs being down in back-to-back days. I think there are a lot of things driving that price reaction, but high level we've gone a long way over the past couple of months. We've essentially rallied for the better part of 6 months now in equities, and so I think they're taking a little bit of a breather because there's a ton priced in, and the positioning is kind of like at extreme levels, from CTAs, from retail, and so you're just having a little bit of a pause in the equity price action.
Yeah, I think it's been one of the sort of stock market or equity market stories that we've been seeing is these monster AI like data center deals. Like I think what Oracle has was it 100 billion or something crazy they announced. Is how much do you think the AI, like broadly speaking, AI hype either from the the Mag 7 or the AI companies is like in the driver's seat for equity markets at this point?
It's squarely in the driver's seat. I think, and when folks think about what's going to drive growth on a forward basis, like it's really like AI companies, and all of the the various downstream companies that are influenced by how much capex these companies are doing, and all the power that they need, etc. So that's largely driven the price appreciation in the broader big indices, and high level as well. Like the Fed easing when they don't really need to is also helping backstop risk a little bit, and it kind of seems like the administration's okay with running things hot, and so equities are moving higher. I do think that the price action in metals is super notable. Gold hitting fresh all-time highs this week once again. We're off a little bit today, but I do think that there's just a big rush from domestic folks, international folks into gold, as a debasement hedge essentially. And that's caused things like silver, platinum, and other kind of related metals to also, perform well. And that's in an environment where, the dollar index is like, fairly unchanged. Like euro's still kind of right around 117-ish, 117.50. And so it's not like there's been a massive like move lower in the dollar. It's just, gold is becoming like a staple in a lot of portfolios. You can see the accumulation in places like China. Retail's involved as well. So it kind of seems like it's becoming like a core pillar of how folks think about managing a portfolio for the long run.
All right, two questions about that. Is that at the expense of U.S. Treasury debt? And two, is comment on the fact that last week during the the Fed cut 25 basis points, but the long end rose, right? Like how do we, is that all, are these all tied together with gold rising, the long end rising, central banks and foreigns stacking gold?
Yeah, no, it definitely is all related. I think on the Treasury issuance side and Fed credibility side, there's a lot of folks that think about what the end state is, and the end state is more money printing, right? Like if you believe that the government can't ever like stop printing deficits, right? Like then that means that by definition we're going to have to print money to finance debt. And so if you know that that's an eventuality, and you know that the math gets harder and harder every day, that you don't, take the hard kind of decisions, then gold's like a pretty easy trade, right? Because it's theoretically it's more finite than dollars. Now, in terms of like why the curve or the back end of bond markets didn't rally too much, well, if you're really thinking about investing in treasuries that are greater than 10 years, like your primary focus, or at least for a lot of people, is preservation of purchasing power, right? And if you think that having like easier monetary policy in the short run will come at the expense of inflation over the longer run, and you want to be protected from a purchasing power perspective, then you probably need a little bit more term premium in the curve. And so it I think it goes back to like specifically what Powell said during FOMC. Their tools are only able to do one thing at a time, right? If you want to cool inflation and simultaneously improve the labor market, you can't do that, right? And like they have limited set of policy tools, and so like trying to address the weakness in the labor market is going to come at the expense of risking more durable inflation over the long run, and that's kind of the trade-off, and the back end of the bond market is reacting to that.
Cool. Well, it's just interesting because remember at the start of the year, I don't remember whether Secretary Besson actually said this or if it was sort of just promulgated as their goal, that it was like getting the 10-year down, and that I know the president has been, one of the things he's been saying publicly in pressuring the Fed to lower rates is that he wants mortgage rates to come down. They haven't meaningfully come down, and it just wonders, like, how long can the administration sort of push for this reduction in actual rates as a consequence of Fed action when it shows that Fed action is not really doing it, right? Do you think they'll come to a sort of a come to Jesus moment where they have to acknowledge that actually the Fed rates might not be the cure here?
I don't know if that there'll be a come to Jesus moment in this administration, not because this administration's different than any other administration. It just simply has to do with the ability to kick the can down the road and assign responsibility to other folks. And so, there are still tons of tools that will keep bond markets and FX markets reasonable for the foreseeable administration, basically, right? There are things they can do, like lowering the rate that the Fed pays on two banks, basically the interest on reserves, like IOER or IORB as it's known, on interest on reserve balances, sorry. And so they could lower that below where the Fed's setting the rates, and that would force a bunch of banks to like enter the Treasury market. They could change other rules to allow for more Treasury purchases. In addition, like they can cut back on back end issuance and make it more front end issuance. And like, so there are things they can do. They can stop QT, like, et cetera. So like there's a lot of like policy measures that can be implemented between the Fed, Treasury, and the administration, that can basically kick the can down the road. Now I will say that Besant started the administration being like, we're going to take deficit spending to 3% of GDP, which is long run sustainable, right? And basically 3-4 months ago he switched to 4%, right? And so it's hard to like take this administration that seriously, because they flinch when they see weakness, right? And like you had the huge tariff sell off, and it's like, I'm gonna backtrack that a little bit. Well, if you want to pass like sweeping changes to the government and you want to spend $3 trillion or $3+ trillion, like it's going to come at the expense of something. And like, yeah, your deficit spending objectives have gone out the window, and like you're not that credible in terms of being able to spend less. But the problem is there's no other solution. Like what, like Democrats are going to come in and spend less money? Like I just like every administration has an incentive to spend more money.
Yeah, you've talked eloquently and at length about this on this program, about the political incentives are totally misaligned for a long-term fiscal soundness.
Yeah, and as long as we're still in 2-year congressional, cycles, and 4-year presidential and 6-year Senate, and everyone's focused on reelection, and everyone's focused on themselves and like the immediacy, then stuff's not going to change, no matter who's in charge.
There you go. Well, Beimnet Abebe, my friend from Galaxy Trading, as always, thank you so much. We'll see you next week.
Thanks for having me.